Welcome to FYI, the For-Your Innovation podcast. This show offers an intellectual discussion on technologically enabled disruption, because investing in innovation starts with understanding it. To learn more, visit arc-invest.com.
Bitcoin is a relatively new asset class, and the market for Bitcoin is subject to rapid changes and uncertainty. Bitcoin is largely unregulated, and Bitcoin investments may be more susceptible to fraud and manipulation than more regulated investments. Bitcoin is subject to unique and substantial risks, including significant price volatility, lack of liquidity, and theft. Bitcoin is subject to rapid price swings, including as a result of actions and statements by influencers and the media, changes in the supply and demand of Bitcoin, and other factors. There is no assurance that Bitcoin will maintain its value over the long term. ARC strongly encourages any investor considering an investment in Bitcoin or any other digital asset to consult with a financial professional before investing. All statements made regarding Bitcoin are strictly beliefs and points of view held by ARC and/or podcast guests and are not recommendations by ARC to buy, sell, or hold Bitcoin. Historical results are not indications of future results.
Hello, everyone. David Puel here. I'm a research associate at ARC Invest, working in the digital assets team. Welcome to Bitcoin Brainstorm. This month, we have a special feature for you. Instead of our usual remote format, we wanted to feature an in-person, pre-recorded fireside chat between our CEO and CIO, Cathie and Dr. Arthur Laffer. He's a renowned supply-side economist that you may know very well at this point. The moderator of this conversation is Preston Pysh, Bitcoin personality, and host of the Bitcoin Fundamentals podcast. This conversation, Cathie, Dr. Laffer, and Preston walk us through their personal experiences related to Bitcoin, Bitcoin's monetary policy and how it relates to supply-side economics, and Bitcoin's positioning as private money in the world stage. The session you're about to see or listen to was recorded in the beautiful facilities of Bitcoin Park in Nashville, Tennessee, on July 23rd, 2024. This is during the week of the Bitcoin Conference 2024. Enjoy.
How's everyone doing? You guys ready to have fun? So these two are fun. We were talking upstairs, and get ready for some funny stories. Dr. Laffer, when he would teach Cathie, he would always start the class with a joke. And so I used some AI when I was preparing for this. So this may be true and this may be false. We're about to find out because I didn't ask him this in advance. It says, and this is my way of starting off this conversation with a joke. Yes. So it says, when you were an advisor with President Reagan, you hid a plastic spider in the Oval Office to scare him or tease him or something. Is this a true story? And if it is, tell us the whole story.
Confidential, secret, and no, I never did anything like that.
You never did this?
No, I did not.
So
who would put a spider? Never.
I can't tell if he's joking or he's serious right now.
The funniest thing that ever happened was with W.
Okay.
Was Ben Bernanke would come sockless. He would wear shoes with bare feet. You know, that's about as weird as it gets.
That was it.
That was pretty weird.
That's not
and then
exciting.
He ruined the economy. But other than that.
Okay. Let's go here. Let's start here. So in 2015, Cathie, you were writing an article on Bitcoin to publish, and you went to Dr. Laffer, who was her old professor at USC, and upstairs he described Cathie as being intense as a student. Just wanted to.
Some things never change.
And Cathie wrote, you guys didn't realize this was like part roast and questions. So you were writing this article on Bitcoin and that it's satisfied 3 rolls of money, and you wanted to get Dr. Laffer's opinion on the article. Talk to us about writing this back in 2015. Talk about what his response back to you was and why you selected him to be the person to help you go through this.
Okay, great. Yes. So 2015, we were intrigued by Bitcoin, had been intrigued since 2011 at my last firm. But at ARC, we could do something about it. GBTC had, really, it was the first year we could buy it. And so, and it's a security. We have to own securities in our ETFs. And so we wrote a white paper, and I did not write it. I have to give all credit to Chris Berniski. I don't know if you know Chris Berniski from ARC originally. Now he's running, he's a partner at Placeholder Venture Capital Fund. Just a brilliant guy. Fell down the Bitcoin rabbit hole, just could not pull him out. He was, and he wrote the paper. Could Bitcoin serve the three roles of money? And the second part of the paper was, what is this? What's the technology here? And so I have, I admire art so much. No economist, I think, is better than art. And I said, okay, I want to put this paper to the test. Let me show it to Art. And so we did that. And Art, there were two things that happened. He said, okay, there are two parts to this paper. One is technology. I won't have anything to do with that. So split it into two. So we did. And then the other one was on economics and a global monetary system. And I remember after he got through, helping us think it through a bit, he said, this is what I've been waiting for since they closed the gold window in 1971. And I said, wow, this is a big idea. Do you remember this?
Yes, I do.
This is a big idea. How big could this be, Art? And you said, now this was when Bitcoin was at a $6 billion. We used to call it network value. I guess that more people now call it market cap. $6 billion back then. How big could this be? Well, how big is the U.S. monetary base? And back then it was $4.5 trillion. Today it's about a little over $7 trillion. And I was thinking, wow, that's a big idea. We were doing our due diligence on GBTC and they so wanted us to buy. They opened up their books. I mean, we saw everything because our compliance team just was not going to have anything unless, we knew everything that could go wrong. And we had to go and ask the New York Stock Exchange permission to put it in the ETF. And they said, okay, up to 1%. So, but they didn't tell us if it appreciated, we'd have to sell it down to 1%. So we didn't. We wrote it to 10%. So it was a great. Anyway, so Art really inspired tremendous confidence. There are two things that have inspired my own confidence. One was that conversation, and two was meeting core developers and understanding how much they understand about monetary policy, the global monetary system, rules-based monetary policy. So, but back to Art. Yes, that paper he blessed. And I have to tell you, from that moment on, I didn't look back. I was, this has not been an issue. People wringing their hands every time it drops, 95% or whatever, which it was back then. And we never looked back, and a large part due to Art.
Well, one thing about ARC, by the way, they did write it up to 10%, but remember, that's just not the numerator. The denominator went up as well, so it's much more than 10%.
Yeah, it did.
It's really amazing there.
Mm.
Yeah, why don't you tell them the three properties of a money, and then we'll go on from there and how to really change this world and make it happen. Yeah. Because as you know, I mean, just to take you back in time, prior to 1913, there was no government-controlled money. It was all private. Now, the government back then did define what a dollar bill was. A dollar was 1/20th of an ounce of gold, or $20.67 an ounce. All right? And we did the silver was an ounce as well. So they did define what a dollar was. And the government also did mint coins, but so did everyone else. You had minting of coins all over the country. And the currency board of currency was just one of those minters. And lastly, the government did have a role in checking on the authenticity of bank reserves as reported by banks. But banks were the creators of money. You had bank notes. They were all bank notes. They all had them in their reserves, and the government checked on those. But it was a private banking system. It had been that way for a long, long time. It wasn't a government-controlled system. And as you know, for the last 200 years, we had pretty stable prices. I mean, much more stable historically. They'd pop up and down a little bit, but they were very stable. And then in 1913, the Federal Reserve was defined as coming in and taking over money. 1933, as some of you may know, with the Bank Holiday Act of 1933, all gold clauses in contracts, private and public, were outlawed, but the contracts were not invalidated because of that. So they were still enforceable, but that clause was not. And then 1933, the clause was also that everyone had to turn in their gold to the U.S. Treasury. All right, which they did. It's in Fort Knox, I think. Mm-hmm. Has any of you seen it yet? But they had to turn into Fort Knox. And then, of course, shortly after they did that, they paid $20.67 an ounce of gold in March of 33 to all holders of gold. And then on September, 6 months later, they devalued the dollar to $35 an ounce, which was one of the biggest wealth taxes the U.S. has ever experienced. I mean, it was an enormous wealth tax. We were the only country, by the way, who did this, who outlawed private holders of gold. And then you keep going on in monetary policy, the interest equalization tax, the voluntary foreign credit restraint program, ever more government control of money in the process, until I think it was the Smithsonian was 71 or 72, where we went off gold officially on international transactions as well. And we raised the price. George F. Shultz, I think, then said, we've just raised the price of a product we will neither buy nor sell. And we really went off. And then you know what's happened after that. I wrote a piece in the Wall Street Journal. You may want to look at it someday, called The Bitter Fruits of Devaluation. And I got letters from Milton Friedman and from Paul Samuelson, and all of them. They're saying how crappy this thought was. It's stupid. But when you devalue your currency, your prices rise relative to the rest of the world's. And we had the double-digit inflation and all that process. And so we had this whole period there of domestic money that was losing its value, unsound paper currency. It's exactly what it is. And now we come to this modern era, and what's just sort of exciting is for the first time we have a couple of alternative monies on the global scale that are not trivial. And what I was talking to Cathie about in 2015 was when I've been waiting for this for a long time, is here you have a private money. I don't know the computer program that the Japanese pseudonym, what's his name, Hayotashi or something, whatever his name is, wrote that thing.
Yeah.
But I assume the program is correct, and I assume it's not breakable, not changeable, and it limits the quantity of Bitcoin, and it has an asymptote that it comes to at 21 million, I think, something like that. And there you have that. You also have something that's similar, that has been much more historical, which is gold. And as the currencies of the countries are debauched and laid bare, I mean, they are really, you can see people moving and shifting more and more towards private monies again, coming back to the old standard. This is what I really see. And what really excited me back in 2015, I mean, it's hard to transact in Bitcoin today. I mean, I was down at my local, I wanted to buy an ice cream cone, and, you know what I'm saying. There are a couple of features of Bitcoin that still need to be worked out, very seriously worked out. One of them is, well, you had that word. What was stable value?
We were talking about stable coins. Yeah.
Stable coins, of which I had no idea what a stable coin was. I was thinking of it on its side, balancing on the table there. And the other one was, I was thinking of some sort of financial transaction in a horse's home. That would be a stable. Oh, never mind. Oh, God. This is a tough crowd. Can I try the one
very serious crowd?
Can I try the one joke that should break
yes,
them? Okay,
yes, let's do this.
I had my medical appointment yesterday, and I went to my doctor, and he said, Dr. Laffer, it's totally inadvisable to ever take a laxative and a sleeping pill at the same time. And then he added to that, he said, but if you do, you're going to sleep like a baby. What really needs to go here, now what we have, I think, is let's say it's 21 million Bitcoin. Let's say $70,000. That's about $1.4 trillion. You're getting up into the numbers there, which make it feasible as a as a monetary base for a world system. We have a gold system as well, which is an alternative private money. There now, the problem with the private money on gold is I think, I don't know what the U.S. holdings are, but I think 8 million tons or some other huge number of gold there. So there's a lot of government control of gold. I mean, one of the things I would love to see government sell off all their gold and just make it a private commodity and no longer have, I mean, I don't know what they do with it, but what really needs to be done with Bitcoin to make it really fit into a global monetary system is the quantity doesn't have to be fixed. That's already done, like it is with gold. But the price of gold has to be fixed in terms of goods and services. In other words, what you have to do is have to have a system whereby you have a price rule, where you have the price of Bitcoin in units of goods and services, the CPI, if you will, has to be stabilized. Because what people really want in their budgets is they want to know what prices are going to be now, next year, 5 years from now, 10 years from now, because the whole idea of long-term contracts, bonds and stocks, et cetera, is based on knowing what the value of the unit's going to be going forward. And it needs to not only be trend-wise stable, but it also has to have low volatility. And then you really encourage long-term capital markets, which is a phenomenally powerful for economic growth, for prosperity, et cetera. I don't know if you're all following me here.
Can I?
Yeah, please follow.
Yeah. Is this okay, Preston?
Oh my God, yeah. I just want to get out of the way. I want you guys to talk.
Okay. No, we ever since the beginning we've had this conversation, and I think as I've tried to reconcile what our research suggests is going to happen here. After all, we are saying that we believe the price of Bitcoin will scale. I think to our bull case is $1.5 million. Let's go. As we move toward the system that you are talking about, Art, and already we are seeing the volatility is coming down. You know, when it was $6 billion in network value or market cap, you know, the volatility was like unbelievable. But we're seeing the volatility come down, and the world you're talking about is, how far out do you think? We think that price target is a 2030 price target. And how will the conversation change? Because, you know, I know that one thing the core developers will not do is change that 21 million units. So can you talk around that?
What you have to do is you have to get governments to decide that they need to have Bitcoin as the currency of the realm. That's what your acceptance of Bitcoin, and political acceptance especially. Once you get the political acceptance of Bitcoin, you get the transactions in Bitcoin. I don't know how they're going to define it or such, but then you're going to get financial institutions coming in where they'll use Bitcoins as their reserves. They'll create their own liabilities in the system, and you'll get a fractional reserve system that'll be run by private sector things, just the way it was with the Bank of England for a couple of centuries there. I mean, you had the Bank of England would sit there and stabilize the value of the British pound in terms of gold. And what they do is meet with the old lady of Threadneedle Street every morning, every noon, every night. That all the major bankers would come in, and they describe whether they were net buyers of gold or net sellers of gold, or net buyers, obviously, of pounds, or sellers of pounds there. And looking at how it was, if they were selling gold, that means that there were not enough pounds in the system, too many pounds in the system. So what they would then do is do an open market operation, contract the number of pounds until the shortage of pounds stopped the sales of gold. Same thing the other direction. You know, when they were buyers of gold in the open market, that meant that there were too many pounds outstanding, too few pounds outstanding. So, you know, they did this every day doing transactions. Every now and then a crisis would hit. You know, there'd be a war on the continent or something like that would happen. And they would have what's called a judicious suspension of convertibility, where they drop out of the market and let the price resettle down and then come back in later on to stabilize. But over the long period, they stabilize the value of the pound. That has to develop. First step has to really be getting governmental acceptance of Bitcoin because of private acceptance. If everyone's transacting in Bitcoin, believe me, the government will start using Bitcoin, and that'll happen. And then you have to have a price rule, even within a fixed quantity, You'll have a price rule. Now, the way Britain did it was with very small reserves. They did not have large reserves of gold. What they did was they just did that 3 meetings a day, stabilizing with buying and selling gold in pounds to just keep the price very stable. I think they allowed a 1% band around the price to be transactional, and then they would intercede if it got above 1% or below 1% there, and they kept the value stable for long periods of time. That's what needs to be done to really guarantee the value of Bitcoin at some future price, whatever that future price is.
One of the things that we discussed as you were reminding me of this history, my perception, again, just looking at charts going way back, was that the world you're describing, the world of private money, was a very volatile world. The output whipped around pretty dramatically. And I remember one of your answers was, and it resonated, was that yes, that's true, but if there were many crises, they were over in a few weeks. The adjustments were quick. With our monetary system, we get an 08, 09, and that built up over years and years and years, right? Would you like to talk any more about that?
Let me just say, Cathie's completely correct. On the financial, we have financial crises all over the place, but not real crises. Unemployment did not exist. Production stayed going. All that did happen was there was a huge flurry of financial asset movements. The owners of financial assets and real assets changed, but they never stopped producing. They just went on. The problem with 2008, 2009, the Great Recession, is they decided that it was inappropriate for people to have losses, too big to fail. The losses were not possible. So therefore, the government stepped in and tried to protect people from having losses. Well, if you prohibit losses, you're also prohibiting profits. And if you prohibit profits, you have all of this laying waste of real resources. So real recessions, real depressions, loss of output, employment, production, all of that was really a very recent phenomenon. In fact, I would guess the first really serious depression we had was right after World War I, was in 22. And then we had the big one, which is all tax driven. All tax driven was 1930, 2930. First one was a tax on traded products called the Smoot-Hawley Tariff in June of 1930, signed into law by Herbert Hoover, passed by the House and the Senate in September, October of 1929. Then you got the crash. Then you got Hoover deciding on January 1st, 1932, to raise the highest marginal income tax rate from 25% to 63%, but it wasn't very much. It was just a little raise. You never, ever raise taxes in a depression. Well, they did. And they raised every tax. If it crawled, they taxed it. If it flew, they taxed it. If it dug holes, they taxed it. If it stretched over and lied back in its back, they taxed that too. I mean, they went from a 25% highest marginal rate in 1931, all right, to 94% by 1944. Is that a good enough increase for you on marginal taxes? I mean, it's just crazy stuff. But this was all brought about in part because of the monetary system, right, and in part because of the tax system.
I don't think people understand that link, that really this started after 1913, the kind of depression that you just described. It didn't happen before.
Just for some context, so he's the inventor of the Laffer curve. So they're talking about taxes and like what's an appropriate amount based on where the economy's at and things like that. So this curve that Dr. Laffer is known for helps governments understand what an appropriate tax rate is so that you can get as much tax dollars as you can, but do it in a way that you're not, 50% tax isn't going to have a top line or a bottom line for a business to be able to pay that long term. And so the curve helps you understand some of those things. And maybe I'm not doing this justice, but it's important for people to know that context about you, sir. Mm-hmm. When I'm looking at what's playing out right now, and you were talking about your experience. So you were the chief economist at the OMB during the Nixon administration in 1971 when we come off the gold standard. When I look at that moment in history, and I look at your role at that moment in history, and I guess I'm looking for qualitatively, when you observe society and you looked at what's going on, does right now feel similar to that, because it seems like that was the transition point of coming off the gold standard, going into this petrodollar system. And I think a lot of people are looking at the petrodollar system as coming to a close, or there's a new era that's brewing right now. Do you see qualitatively throughout society a similarity to that moment in time back in 1971?
Yeah, they're awful policy. Let me make sure you understand that I focus a lot on taxes, and the taxes are really important. And the reason I focus so much on taxes is they're easily changed, quickly changed, and very subject to political manipulation and campaigns and stuff. Just as important as government spending. How you collect your money matters. How you spend your money also matters. And how much you spend and collect matters. That's government spending. Sound money, which is what we're talking about today with Bitcoin. That's equally as important. There's nothing that can bring an economy to its knees quicker and faster than unsound paper currencies. It's just nothing. And that's why I love Bitcoin, because I think you guys might just be able to fulfill that role and keep the prosperity of the world going. Next thing is regulations. I mean, regulations are crazy. I mean, they can do a lot of damage. And lastly, trade. I mean, this country, the U.S., was built on trade. I mean, from 1640 until about 1780, we ran deficits. We ran trade deficits every year, except for maybe 5 or 6 years. I mean, 1640 till 1870? What's that? 230 years. I think we had 5 years of surpluses. 1775 and 1776. Duh, They didn't provide us the capital. 1812 and 1813 were two of them. And then there was one more in the great collapse of the canal bonds in 1840s where we ran. But capital debt, trade deficits, our capital surpluses. We built our world here in the United States with foreign capital. We brought the capital in with the land and the people and created this huge phenomenon of economic growth. So free trade is equally important. Today, those 5 pillars of prosperity, they are varying as to how much damage or how much benefit's being done. Taxes are nothing like they were when we came into office in 1980, for example, at least personal income taxes. Now, the total taxes were. Government spending is much worse today than it was back then.
And
much
spending
worse.
Is taxation.
Spending is taxation.
Yes.
But you have taxes, then you have government spending, then you have sound money. Today, we are not as bad as we were. I mean, when we took office on January 20th, 1981, the prime interest rate was 21.5%, people. Mortgages were 17, 18%. I mean, that's a lot worse than it is today. But still, today is really bad. And then regulations probably today are not quite as bad as they were back then. Back then, we had wage and price control. I mean, you can't imagine how bad corrupt governments can get. And trade is a key one now. Today, trade is just off the wall bad. I mean, the one thing you want to make sure you do is trade with your arch enemies. You don't want to boycott them. You want to trade with them. When you trade with people, you have your suppliers and your demanders, and you have dinner together and you talk things over. When you boycott places, trade is not a political or military weapon and never should be used as such. We have the State Department to do the political bullying, bully pulpits. Then we have Defense Department. If they're really bad people, shoot them. But do not use trade as a political weapon because it doesn't work. It really is bad. We should be trading with China, with Russia, with Iran. I'm not saying we should sell them nuclear weapons, but we should sit across the table and do business with them because that's how you understand and how you get to peace.
So, Art, can
Yes.
I interject here?
Sorry,
Because I think, no, this is good. I know that you advised President Trump as you have advised many, I think most presidents in the last, 4 decades? 5 decades?
10 decades.
Okay. But one of the things that, of course, President Trump is animated about is trade and exactly the issue. So, and I know you do compare notes and everything. What is he doing? He must agree with you. He's a good businessman. What is he doing when he rants and raves about our trade deficit?
Rants and raves. I love those phrases. Trump is a negotiator. And Trump is an international business leader. As every international business leader is, he's a free trader through and through. But how does he ever get these people to come down? Their barriers their non-tariff barriers, their quotas, their tariffs, all of this stuff
IP.
hurts us terribly. And so what he tries to do is bring them to the table. And there's nothing better than threatening them with not having access to the U.S. market. My view of Donald Trump is, and it's mine, that he uses threats of tariffs to bring them to the negotiation table so he can negotiate free trade deals. He did a really great one with the North American Pact. He did the one with South Korea. He's done. Look at what he's done, and they're all free trade deals. Now, when he was in Ottawa, in the great G7 meeting, just before he met with Kim Jong-un in Singapore, he had to leave the G7 meeting a couple of hours early, and he apologized to all the attendees. He said, "I'm sorry, I have to go there. I'm going to meet with Kim Jong-un. You really want me to meet with Kim Jong-un if you want peace in the world," which he does. He said, "You do, but I've got one deal for you to propose to you before I leave. The U.S. is prepared today to negotiate and get rid of all tariff, non-tariff barriers if you are too." And they all looked up at the sky. They looked down at their shoes. No, I mean, Trump, I believe, is a free trader of immense proportions, and he uses tariffs to bring these people to the table to negotiate. When he does that type of talk, I'm not a negotiator. I don't know how to negotiate. I go to my fallback position instantaneously. I climb under the bed. I roll up in a fetal ball, and I start crying and wetting myself. But he does know how to negotiate, and he really does. And how do you negotiate and get free trade rather than talk about it? And, talk is cheap. Deeds are really serious. And when you want to get deeds, you want to be able to bring them to the table so that they bring down their trade barriers. And that's the way I think he is. But, to get his actual positions, you got to call him up. And I've got his number if you want.
So, Preston, we've strayed from your line of questioning.
No.
Yeah.
So I think a lot of people in here, shifting this back to Bitcoin, I just think that everybody here would just love to hear from your perspective, the launch of all the Bitcoin ETFs. How is this being viewed on Wall Street by people that have been launching ETFs for decades at this point? Is this, I'm assuming it's a massive success, but like in your own words, help everybody kind of understand that point of view of somebody that works with some of the elite people on Wall Street, how this is being viewed.
Yeah, I think Larry Fink's conversion was very important. That was a moment. Remember, he was denigrating Bitcoin for years, very focused on the environmental side of it. But how is it perceived? Well, the first thing that happened was Grayscale, because it kept its fee at 2%, donated a lot of share to all of us. Right? I mean,
why was that? That just doesn't make any sense.
Well,
why they kept
put
it like
this way. We think it was a miscalculation, and the CEO, who I've known him for a very long time, he quit. I think, and now they're putting. If you look at what they did with Ether, they have they've introduced not only the conversion into the Grayscale trust into an Ethereum ETF, but also an Ether Mini for 10% of it. So the cost there is 15 basis points. And I think I don't know if they're keeping it at the rest at 2%. I don't know. I don't understand the strategy. But first donated a lot of share, grew the market in terms of, beyond what Grayscale offered. So the education of 11 ETF providers vying for business at the same time, the education around that was tremendous. And you had most of the major asset management institutions involved, whereas, when we were in our early days, they thought we were using a marketing gimmick, or there was, always a reason not to consider what we believed was a new asset class. So first, donation of share to lots of other players, all of whom have educated. But the most interesting thing is it really has not hit yet, because the big platform, we call them wirehouses. So Morgan Stanley, Wells Fargo, Bank of America, Merrill Lynch, LPL would be an independent one, UBS. None has approved them for the platform. And everybody.
Is that the 6-month mark I keep hearing that they needed some?
I don't know what, yes, that we were told by the most progressive of all of them, we need 3 to 6 months. Okay, so now we're 6 months in. And I'm sure at one point, price hit 70. They thought, oh, we can't put, this is very volatile. We can't put our clients in this. We'll wait for a correction. The correction was much more shallow than they expected. There was one immediately after launch. But no one jumped on the recent one, which is interesting. So I think they're still trying to get their arms around it. They probably have to hire analysts to support them, because otherwise it's on the management team's backs. This is their risk. So I think they'll have to get a little bit of an infrastructure going. And we're starting to see that. We're also starting to see some demand pull from clients, which is good. That will get top management to make the investments in the research team to make this happen. So it's a slow process, but, despite what seems to be a wonderful success, it hasn't even begun.
And I've heard, because you don't have the financialization of derivatives on top of it, which could come within a year from now,
Yes.
that's going to bring a whole nother flow of cash towards it. Can you help people kind of understand what that means and what that might look like?
Yeah, I mean, this is all deepening the liquidity of the market, which is that's a lot of what they're studying right now. How liquid is this market? Do we need derivatives? We'll wait for derivatives. I mean, they will use, I think, when one goes, though, the others will follow quickly. So I don't know if they'll wait another 6 to 9 months for derivatives. Maybe. I think someone will jump the gun before that, especially because it's become such a big campaign issue. And you've got, former President Trump, taking donations in crypto. Wow, that was surprising. But saying that he would guarantee the right to self-custody, very big in this community, right? Very, very, very big. Focusing on the miners and saying, yeah, America first. Yeah, we need them here. That's great. That was wonderful. And then, of course, what happened in Congress, the idea that the FIT 21, so Financial Innovation Technology of the 21st Century Act, FIT 21, got 76 or 78 Democratic votes in the House. Nobody expected that on Wall Street. Maybe that was becoming current wisdom, but that was big. I think, in terms of what I just said. The financial markets are waiting for cues to say, okay, it's okay to go. It's okay to go.
Based on everything we're seeing from a macro standpoint, it just seems like anybody that would be buying a 30-year bond fund ETF in the US, Europe, any basically NATO country that has a 30-year bond fund, it's almost looking at where the math has to go for everything that's happening in the backdrop, that it's who in the world would want to own that. And it almost seems like the Bitcoin ETFs might provide some type of way to make those more desirable. Call it a 2% Bitcoin, 98% 30-year Treasury.
Done great work on this. Yeah.
So talk to us about that. Is this where maybe even the S&P 500, 2% Bitcoin, 98% S&P 500? Talk to us about these hybrid vehicles that might be on the horizon to try to protect people's buying power.
Rod is.
I'm like, all right. I am terrible to stop this going, because have you had Cathie on your podcast yet?
Cathie's come on the podcast. I haven't interviewed her, though. Someone else has interviewed her.
Okay. You need to go on Preston's podcast, and 100%. We're 45 minutes in, and I feel terrible that I have not opened it up for
Q&A.
Questions. And I know you have an earnings call, I believe, a little after.
Don't worry about that. Okay. We're here for you.
Okay. I appreciate it. Do you want to answer this question, then I can open it up? Or
sure, I'll answer the question. Yes, I think once I think financial institutions become comfortable with the liquidity, And they're going to start, and our industry has scaled because of, companies saying, okay, we can structure a portfolio in this way. And here's the return risk profile of this portfolio. And, advisors in particular know what the risk return profile, when they get that kind of information, like providing your I know you've done great. You should be presenting this on how much more productive Bitcoin 2%, Treasury bond 98% would be relative to just bonds over time. And I think that will continue, and they will be onto it. But, and it's important too, because advisors are always thinking about risk, especially given the last 25 years, tech and telecom bust, 0809 meltdown, COVID, and so forth. So they're always thinking more about risk than return. And you're presenting them with a very interesting dynamic, which is, as we said, the 2 and 98%. This once we get some of these platforms to approve it, we're going to see all kinds of products like that.
I noticed you have my favorite book here. Well, not my favorite, but I love this book. If you guys haven't read the code book, or you can get one thing that's really important about money, and really important, is anonymity.
Exactly.
You need anonymity, period. And if you don't have it, it becomes an instrument of the government to go into your private life if they can trace you back. And anonymity is reasonable, easy, and trivial to solve. Read the code book here. If you want to do it. I think I recommended it to you.
You didn't only recommend it to me. After our meeting, you sent me this copy.
Okay, I sent him the copy. You've got to understand the math, and you got to think of quantum security issues, encrypting, and all of that. But it is trivially easy using prime number series to be able to guarantee anonymity, where you and the other party have the code break, and there's no way it can ever be broken, period, done, all over. The winners now are the encoders, and you can do that with Bitcoin and make it happen.
It's so interesting what you're saying. When I started in the business, really started in the early 80s in New York, active equity management that's all there was, really. And then we hit the tech and telecom bubble and bust. We hit 08, 09, we hit COVID, and the risk aversion in the markets today. The reason that younger people like our strategies is for the same reason they put up with the volatility, and ours have been extremely volatile, especially lately, is because they know we're doing the research, and they know this is the way the world is going to work. So they will do the right thing, which is, okay, average in, or however they do it. I have found the fortitude of young people has been enhanced by the Bitcoin movement in terms of our strategy. There's no way we should have retained the assets, in the old world that we have, except for the younger people coming in, and people, not just younger, but people who are very interested in the research, how the world is going to work, not how it has worked. We're in the biggest moment of, disruptive innovation in history, with Bitcoin a prime example.
Huge round of applause real quick.
Thank you.
I'll open it up for one question while we have time. Cathie, we were just on a podcast with Jack Dorsey, Matt Odell, Alex Gladstein, and Mike Schmidt from Brink.
Yes.
I think you're taking it a little bit even further right now. The research that you started in 2015, the team that you assembled early on, purchasing GBTC, and now with ARCB and such. I know we're going to publish it, I believe, on Thursday, but maybe for this audience, do you want to maybe mention
what we did? What
you guys are doing in terms of giving back?
The podcast. Yes. And actually at the last time when we were, I don't know, Texas Consensus, right?
At Bitcoin Commons.
Bitcoin Conference, Texas. That's right. We gave a preview, and on this podcast, we announced what we're doing. we had intended before the Bitcoin, spot Bitcoin ETF was launched, we had intended to take a percentage of the fees and donate them to open source developers. But what happened when 11 came in at the same time and this fee war began, we pivoted and we said, wait a minute. Okay, so the fees will not be 50, 60 basis points. They will be 20 basis points roughly. And so we're not really going to make any money on that, but that's okay because Bitcoin, we believe, is a public good. This is financial superhighway. Everyone should have easy access to it and learn about it because when they start with an ETF, they will learn more and then they will want to do more in the way of self-custody and just get more involved into the community. So we decided not to do it then, but we've launched private funds, much higher fee, and we're not going to donate a percent of profits. We're donating a percent of revenues, and the percentage. Well, the first year. Do I give a number of first year?
I don't know, David Pouillet, compliance.
David.
Well, let's just directionally say some numbers, maybe. We can cut.
Don't risk it.
Don't risk it.
Don't risk it. All right. Well, anyway, the private funds are not profitable yet. And yet we're using that percent of revenues this year and actually donating more than that percentage would be because we're just ramping. So, and I think it's, for those organizations, meaningful enough. It's certainly, and as our private funds scale, and we think they will, the donations to the core developers, the organizations who donate then to the core developers, will only scale.
Where do you go, Cathie?
Yeah, thank you. Thank you.
Anyone have a pressing question for Dr. Laffer, Preston, or Cathie? Yes, Steve Myers.
So you were talking about how eventually the price of Bitcoin will somewhat stabilize. It's always going to be volatile, but the volatility will decrease. What is that going to do to other assets that are currently financialized and used as savings accounts?
That are tied to fiat. Like,
What's that?
Like treasuries, I think is your
treasuries, real estate, the stock market.
Because I have my opinion.
I'm just curious because if you're assuming that eventually we will get to this point, what does that do to the rest of assets?
Well, this is a new asset class. We wrote that paper, Bitcoin, ringing the bell for a new asset class. And what it does, I may not be answering in the way you expect me to, but what it does in terms of the way the financial markets are set up right now, and I agree, they're going to have to change, and they will change, but any fiduciary knows that if you introduce a new asset class into your asset allocation, the correlation of the returns associated with that asset class are going to be low relative to the other assets. So it's important to include it to increase returns per unit of risk. It's that low correlation that lowers the risk of the portfolio in general. So, that's how we've positioned what's going to happen near term. Longer term, I guess, we shall see. I think there are going to be share shifts in terms of this asset class, given the kind of appreciation we expect. We think its share of asset allocation will go up fairly significantly. And we did a study on that as well, using, minimizing volatility, maximizing Sharpe ratio, all the things that traditional financial asset allocators look at. And right now, or in our published piece, we said, you should start out with at least 2.5% to 5%. And that is how a new asset class starts. I remember in the 70s, when I was very new to the business, real estate was a new asset class for pension funds. Then in the 80s and 90s, emerging markets became a new asset class because MSCI had basically said, you don't have to take a risk on what this country or that country. Here, we're going to bundle these. So it became actually a new asset class. And here we are at the threshold of yet another new asset class, Bitcoin leading the charge. So I think the ramifications for Bitcoin are going to be quite significant, and it will take share, as will other crypto assets, I think, from traditional financial assets.
So real fast, is the item that you're talking about tethered to physical reality? So are we talking about goods and services that have some form of scarcity to it? Because if you are, and I would quantify profitable equities as part of this category as well. And then let's measure it through time with Bitcoin and fiat. Okay. As we're looking at that timeline of those two things, in fiat terms, it's going to get more violent and volatile. In Bitcoin terms, throughout time, it's going to get more stabilized and kind of what Dr. Laffer was talking about.
That's exactly what you see as it edges out and pushes out government money. It's much more like the history of gold than it is the history of real estate or the history of other companies that have, what you call them, commodity-based or value-based in the food and all those things that have a net value. This does not have the net value there. It has the net value of paper currency, but it has the stability of the limit, and it has the ability to circumvent the manipulation by government, very simply. And when you look at the history, manipulation by government has been declining dramatically in all sorts of areas. The highest marginal income tax rate in 1944 was 94%. Today it's 37%. In 1960s, highest corporate rate was 52%. Today it's 35% under Kent. I mean, if you look at 1976, only one state did not have a death tax, a state death tax. Today, 38 are without death tax. We are moving very much in the correct direction towards freer markets in this society. We have a couple setbacks, Biden and some of the others, but very seriously, we are moving in the right direction. And this is part of that direction. It's part of across the board and freeing of markets. And you should be very optimistic about the future because of it.
One thing I'll add there, and Yassine El-Mandra, who heads up our digital asset strategy, brilliant, wrote a paper. It was a little bit after the regional bank crisis in spring of 23, when Bitcoin went up through that. And as we were, again, this is all part of education, we're saying this makes sense in a financial crisis where counterparty risk is the question. Bitcoin becomes a risk-off asset. Interestingly, this past week, is it this week or last week when CrowdStrike, was it last week or this week? Friday. Yeah, that's right, because people were stuck at the airport. So yeah, terrible. You notice Bitcoin rallied. It was as we were doing our brainstorm and we were talking about, wait a minute, most people in the financial markets, and this will be another conversion moment too, think of Bitcoin as extremely risky and can't even imagine anyone classifying it as a risk-off asset. We're out there saying, yes, it is. It's risk on and risk off. Think about that. How many assets are like that, right?
Yeah, it's exactly what gold was.
Yes.
Gold is the first refuge of the cautious.
Yes.
When everything else is going to hell, you move into gold. The relative price of gold rises during collapses and wars and all that. And this is a risk-off asset. It's just what it is.
And we chat back and forth because I'm so fascinated by what's going on right now. The gold price has broken out. Bitcoin's been very strong. The gold price has broken out. Normally you'd say, okay, inflation. If you look at the ratio, I'm going back to the same chart because it's even breaking down now. The ratio of the metals price to the gold price. If you look at that, you will see that we have dropped, meaning the purchasing power of gold has gone up to where we were in 0809, and we're threatening to break down from there. So in my view, and I'd love to get pushback if anybody has thoughts, but that this move in gold and Bitcoin, there is a risk off component to it. China is blowing up. The debt is overwhelming that economy, and it is exporting deflation big time. And so I think, and it's interesting to watch the equity market hit all-time highs thanks to the Mag 6. But I wish I could show you this chart, and we'll send it to you if you want to send it to this group. A fascinating chart. It's a Goldman study, and they took the highest market cap stock in the U.S. equity market, all equities, all markets. And they divided the highest valued stock, not valued by PE, but the highest market cap, divided by the 75th percentile market cap. Today it's at 800. Its range has been 100 to 750. And that 750 was in the Great Depression. It was 1932. So what was going on back then? So we had the unemployment rate rose to 25%. GDP dropped by 30%. And you had the PPI and the CPI down 25 to 30%. So in what was happening, 1929, 30, 31, 32, what was happening was the market concentrated towards those stocks with cash hoards, free cash flow, AT&T, new innovation, telephone was at the top of the list. And that was a scary time. This is what happens either in scary times or right before a bear market. It happened in 1973, happened in 2000. We think this is, in our view, this is more like 1932. It's going to be very interesting to compare notes on this, given what was going on then with taxes and so forth. But what happened then over the next 3 years is the market shot up and broadened out, and the mega caps way underperformed, but the market was very strong. So anyway, I don't know why I went off on that tangent.
So Dr. Laffer, you mentioned that prior to 1913, there was about, I think you said 200 years of price stability.
Well,
And then at a different moment, you talked about how, in your view, there needs to be price stability tied to Bitcoin somehow. What factors or events do you think need to happen to bring about price stability somehow tied to Bitcoin?
Well, what happened in the previous period was a gold standard for the 200 years there. And even after that, there was a semi-gold standard, Bretton Woods and all of that. And what needs to be now is a Bitcoin standard has to be set up. Bitcoin cannot be a numeraire, cannot be a means of transaction unless you can assure its stability and value and for long-term contracts. And that means replacement of currencies with Bitcoin. I mean, basically, that's what I think can be done here. What they need to do in that is government needs to accept the private currency view and then stabilize the value of Bitcoin in terms of goods and services. And that's not a very difficult process in normal times to do.
Is that a market cap of like 30, 40 trillion? Where does that start to
Cathie
happen?
did it. What was it? 5 trillion, 7 trillion. What was the monetary base?
But if our price target is right, 1.5 million times 21,
You're like 20, or what is that, 30 times where we're at right now in market cap. So you have to be 30 trillion-ish, somewhere in there.
Well, I don't know about the calculation you're doing there. That might be the total quantity of liquidity needed.
Yeah.
But what you'll have is private liquidity. You'll have synthetic Bitcoins in banking types of operations where they'll have 40% of their reserves in Bitcoin, and then they issue liabilities and assets in Bitcoin terms. So you'll have a lot more liabilities, bank liabilities, which is what we call money. And that will be determined in Bitcoin. And you've got a government that sits there and stabilizes it in terms by buying and selling Bitcoins to stabilize the value of the currency in terms of Bitcoin in terms of goods and services. And that's what you really need.
This is at equilibrium. So this is where we go back and forth, with that between now and then. We're evolving this ecosystem. Importantly, can I just say why I went on that little rant? It's because the last time we saw the concentration in the equity markets to this extent, and we're higher than we were in the Depression, was in 1932. And I am looking at the gold price today, trying to discern, okay, what is going on here? Is it playing its risk off role, or is it telegraphing that we're in a major inflation? And I think it's more the risk off right now. I think Bitcoin's part of that too.
Yeah. I'm sorry, just a quick follow up on that. One of the things when I think about like the monetary base is that we're artificially underrepresenting the monetary base because so much monetary premium has spread across real estate, treasury, whatever. Do you have any view on where the monetary premium has accrued over the last 53 years since 71? And that distortion in monetary premium across other assets, and where you would want to see or expect to see the monetary premium sort of regroup around a more certain asset?
Like Bitcoin.
I don't know.
Just for success. Yeah, I mean, that's what you'd really like to do, is have it so that the value there is such. And I don't know how much that value would be, but I would look at it basically bank reserves is the system there. And I don't even know how much Bitcoin you have to hold in the sense of government and roles there for that to occur. But, you can have lending operations with fractional reserve systems, and in a stable society with reasonable laws and monetary policy, fiscal policy, tax policy, regulatory, and trade, you can have that with fairly low reserves. So you can have a fairly large money supply, Bitcoin money supply, where the marginal cost is effectively zero or very, very low. And you can just get basically transactions medium in there that would facilitate an enormous expansion of the real world, of the real economy. That's what Bitcoin's role will be. Bitcoin, I mean, I hear all of you talk about the investment in Bitcoin, and that's all nice and good now, but that's today's world. The next world comes is where you hit that equilibrium, and then Bitcoin really replaces monies and becomes that asset. It's no longer the investment one, which you talk about risk off and all of that. That role will change dramatically. And what you've got to remember also is that in the Great Depression there, when the price of gold was changed from $20.67 an ounce gold to $35, which is in March of 1933. When that happened, gold was the dollar. And gold was the dollar. So the only way the price of gold could rise is if the price of goods and services fell. And that is what happened during that period. Milton Friedman has it all wrong on this thing. It wasn't the Fed tightening there. It was the people wanting to hold gold and silver that really caused the collapse there in the fish system. And it wasn't the Fed, it was the taxes that did that, and the risk off on gold. But when you risk off in gold, and gold defines what a dollar is, the only way you get risk off is if the price of goods and services fall. And that's what happened during this period. My view is that in the 70s, we had the exact same thing happen. Only this time it wasn't gold. We had the price of gold go up instead of the price of goods going down. We had inflation, but we had the price of gold going from $35 an ounce to $850 an ounce. That's a fairly steep appreciation, wouldn't you say? That's the one you don't want. What you want Bitcoin to do is no longer be an investable asset. You want it to be a monetary standard that replaces public money. And that's what you really
in the
want.
world you describe, very, very low inflation. I mean, consider the source, but I do think that, real growth stocks are the biggest. They're the biggest beneficiary, because inflation and volatility, and just the risk averse nature of and interest rates.
But she's talking about assets now here in the thing that's wonderful.
Yes.
I'm talking unemployment will be
That's
zero. Productivity will be high.
Great.
The humanity will be better served by the economy in the world. It's a global phenomenon of eliminating poverty and despair and unrest and creating this opportunistic proof of growth in the world. It's the biggest plus that's ever been done for humanity, is developing a sound money.
Now, usually,
Let's go.
So you see how excited Art is? All right. Can I say what you usually say?
Go ahead. Say it.
Yes. Yeah. Which is Art is going to turn 84 years old on August 14th. And I have never seen him look so vibrant and young. He is so excited by this movement. He really is. Yeah.
The president said that to me just a couple of weeks ago. He said, you look, oh my God, you look younger than I am and all that stuff. I said, stop. Just stop right there. When I get out of the swimming pool and I stand in front of a full-length mirror and I put my arms out like this, I got so damn much skin hanging down that if I could hook it to my ankles, I'd be a flying squirrel in a windstorm, So stop this crap. I am really old.
Well, one more massive round of applause for these counterparts. Thank you. I knew I should have budgeted 6 hours. David and Nicholas, sorry about we went a little over as well. You gave me this book, the code book, as a present.
Read it, guys. Read it. If you want to understand the math without doing the math, read it about the prime number filters that you can do here, and you can guarantee anonymity. You must have anonymity in Bitcoin. Otherwise, it will never make it.
So to that point, when I met with Dr. Laffer, it was like a 30-minute meeting that turned into 2.5 hours. I actually brought a monitor, a Bitcoin miner, and I was wanting to show him how Bitcoin worked. And we went down this private money rabbit hole, and I was like, all I thought was, he's super based. He gets it. And hopefully you're advising potentially the future president of the United States. So I know that we could have gone on a number of different topics. One we did not talk on was energy and the use of it. I'm not going to bring that up right now.
I'd be like Elon Musk. If they consistently raise these annoying issues, I'm going to hang up.
That may have been on a Twitter Spaces that we were hosting.
Spaces, he was replying to me.
That's right. That's right. Well,
were you the one?
Oh yeah. So,
and I cheered him on my phone. Just, hey, Elon.
Hopefully we can turn that around, because I'm going to just gift you a home miner. That's a future bit, Apollo 2. And I think home mining is one of the fastest ways to learn about Bitcoin. You're mining Bitcoin, you're using energy, you're looking at your energy costs. Maybe you guys it's all in on energy, hopefully. But I can't wait for the next time we meet. Thank you again. One big round of applause, everybody.
ARK believes that the information presented is accurate and was obtained from sources that ARK believes to be reliable. However, ARK does not guarantee the accuracy or completeness of any information, and such information may be subject to change without notice from ARK. Historical results are not indications of future results. Certain of the statements contained in this podcast may be statements of future expectations and other forward-looking statements that are based on ARK's current views and assumptions, and involve known and unknown risks and uncertainties that could cause actual results, performance, or events to differ materially from those expressed or implied in such statements.